September 24th, 1869. Broad Street, the Gold Room. Men ran into the street shouting prices as if language itself had broken. The board showed gold at 162, then 155, then lower, fast enough to ruin you before the messenger reached the door. And this is the part most people never hear. The man who helped engineer the frenzy was already protecting himself, not outside the system. Inside it, Jay Gould, president of the Erie Railroad, had spent weeks helping build a corner in the gold market through political access, private channels, and one critical belief that the U.S. Treasury would stay out long enough for the price to keep rising. Donald P. Morgan and James Narron, writing for the Federal Reserve Bank of New York in 2016, describe it as one of the most scandalous market manipulations in American history. PBS states the collapse began when President Grant ordered the sale of $4 million in government gold. In a market that small, that order was not a headwind. It was an execution. But the street-level anchor here is not Gould. It is Abel Corbin. Corbin was not a random speculator. He was married to Virginia Grant, the president's sister. He had the kind of access ordinary men on Broad Street could not buy at any price. And still he was used. PBS records that Corbin lost heavily in the break, while Gould escaped by selling before the full collapse. That is the forensic heart of the story. Even an insider to the President of the United States could still be the disposable layer inside a larger scheme. So this episode is not the origin story of a shopping holiday. It is a case study in something colder, a market corner, an information hierarchy, and a betrayal timed to the minute. The original Black Friday had nothing to do with shopping. To understand why this worked at all, you have to leave the chaos of Broad Street and go back to the monetary system the Civil War left behind. The United States in 1869 did not run on one clean, trusted national dollar. It ran on layers. Greenbacks for daily circulation, gold for settlement, imports, customs payments, and credibility. Paper for the street, metal for the state. And that split mattered, because when a country tells you one form of money is legal, but treats another form as the real reserve, it creates a pressure point, not everywhere, in one market, in one price, in one nerve center, New York. Donald Morgan and James Narron at the Federal Reserve Bank of New York describe a public gold market small enough that an attempted corner was plausible, with roughly $15 million in gold available for trading. That is the key number here. Not billions, not an ocean, a pool. Small enough to thicken, small enough to choke. And once you see that, the rest stops looking irrational. Gould did not need to control all American wealth. He needed to control a bottleneck. If you could push up the price of gold, you could distort the price of imports, unsettle credit, hit merchants, and make the whole financial press sound like the world was ending, which, for men caught on the wrong side of those contracts, it was. But there was another layer. Treasury policy. Secretary George Boutwell had been selling government gold in regular interventions to stabilize the market and support federal finance. That meant no corner could survive if Washington chose to break it. So the real problem for Gould was never just buying enough gold. It was knowing whether the government would sell. That is where Abel Corbin enters the story for real. Not as a mastermind, as a bridge. Corbin was a newspaperman and financier. More important, he was the husband of Virginia Grant, the president's sister. He was family. Close enough to be useful, not close enough to be safe. PBS notes that Gould cultivated Corbin precisely because Corbin could help him reach President Grant and shape the president's view of high gold prices as beneficial to farmers and exporters. That argument was not random. It was a political cover story for a speculative operation, and this is the trap. Corbin thought access made him stronger. It made him valuable to someone else. By the time the market started rising in early September, the scheme already had its essential ingredients: a narrow market, a government with the power to crush it, and a family connection that men like Gould believed they could turn into advance warning. Next came the mechanism. Not rumor, Not crowd madness. Access. So how do you corner a market that the federal government can destroy at any moment? You do not start with gold. You start with access. Jay Gould understood that a successful corner required two things at the same time: relentless buying in the gold room and some confidence that Washington would not suddenly dump Treasury gold into the market. The public drama would happen on Broad Street, but the real battle was over information flowing out of Washington. PBS's account says Gould and his circle tried to persuade President Grant that higher gold prices would help Western farmers by making American grain cheaper abroad. It sounded like policy. It was position defense. And Abel Corbin was central to that effort, because Corbin was not just another speculator chasing a move. He was Grant's brother-in-law, married to Virginia. Grant, useful, precisely because he could get near the president without looking like a Wall Street emissary. That made him the perfect bridge between a private scheme and public power. PBS described Corbin helping cultivate Grant while Gould pushed the idea that the Treasury should refrain from selling gold. But proximity to power was still not enough. They needed someone inside the machinery. That is where Daniel Butterfield enters. PBS states that Corbin convinced Grant to appoint General Butterfield as Assistant Treasurer of the United States, and part of Butterfield's role involved handling government gold sales on Wall Street. In return for a share of the profits, Butterfield agreed to warn the schemers when the government was ready to sell. That is the mechanism. Not prophecy, not market genius, advance notice. And once you see that, the whole structure sharpens. Gould did not need to know the future. He needed a narrow window, a few hours, maybe less, enough time to lighten exposure before everyone else understood the state was about to intervene. The 1870 congressional investigation exists because Congress understood the same thing. This was not merely a volatile day in the market. It was a question of whether public office had been used to feed private speculation. The House Committee on Banking and Currency issued its report on March 1, 1870, specifically to investigate the causes of the gold panic. And here's the human detail that makes the pattern harder, not softer. Corbin was inside the family circle around Grant. He had exactly the kind of access most men in the gold room would have killed for. But in Gould's structure, that did not make Corbin a protected partner. It made him an instrument, a courier, a political adapter between worlds. Useful on the way up, disposable on the way down. That is why this story matters now. Because when markets become dependent on state communication, the decisive asset is not the security being traded. It is the order in which people receive the signal. Gold was the object. Information was the edge. By early September, the scheme stopped being theoretical. It started moving the tape. On September 1, Gould and Fisk began buying aggressively through allied accounts, using names that concealed how concentrated the position was becoming. The purpose was simple: absorb supply, force shorts to scramble, and make every hesitation by the Treasury look like permission. Donald Morgan and James Narron at the New York Fed described the public market in gold as so small that a corner was genuinely possible. That is why the rise mattered so quickly. In a deep market, buying like this is noise. In a narrow one, it becomes gravity, and the price began to lift. Not all at once. That would have drawn too much resistance. It moved in steps, enough to build confidence, enough to pull in followers, enough to make men believe they were watching a powerful trend rather than being invited into a trap. This is how corners work at street level. First, the move looks justified. Then it looks inevitable. Then it looks safe. By September 22nd and 23, gold was surging into the 140s. The market was no longer reacting only to buying. It was reacting to what traders thought Washington would not do. Every hour without a Treasury sale strengthened the scheme. Every rumor that Grant had been persuaded strengthened it more. PBS records that Gould and Fisk had spent weeks trying to convince Grant not to release government gold. So by the time the market accelerated, price and politics had fused into one story. That is the dangerous phase. because once a market depends on state restraint, every participant is no longer trading the asset. They are trading an interpretation of power, and Abel Corbin was still inside that machine. Think about his position. He had the presidential family connection. He had capital committed. He had every reason to believe he was not just betting with the crowd, but alongside the men shaping the outcome. That is what makes him useful as a forensic anchor. Corbin was not foolish. He was structurally misled. He mistook access for protection. Then the signal changed. On September 23rd, Grant's patience broke. After seeing evidence that Corbin was speculating and realizing how close the ring had come to him personally, Grant met with Treasury Secretary George Boutwell. The decision, according to standard historical accounts and the later congressional record, was to sell government gold if the rise continued. Gould understood the danger almost immediately. Not the public, not Fisk, Gould. And once he knew the state was preparing to act, the corner ceased to be a corner. It became an exit race disguised as a boom. Here is the detail most people remember as drama, but fail to read as mechanism. The betrayal did not happen when the market broke. It happened just before. By late September 23, President Grant had concluded the speculation had gone too far and authorized Treasury Secretary George Boutwell to intervene. The next day, Boutwell ordered the sale of $4 million in government gold. That is the documented state action that shattered the corner. But the crucial question is not only what Washington did, it is who understood it first. PBS and the New York Fed both described Gould as the man who got himself out in time, while much of the street was still leaning the other way. And Gould did not behave like a man who believed the rise would continue. He behaved like a man preserving his own skin. Historical accounts consistently describe him selling through brokers while keeping up the appearance of support. That mattered because the market was still treating Gould and Fisk as if they were leading the advance together. But they were no longer in the same position. Fisk kept talking bullishly. Corbin stayed exposed. Gould reduced risk. The crowd saw a corner. Gould saw an exit. This is where Abel Corbin becomes more than a side character. He becomes the proof. Corbin had done exactly what a useful insider is supposed to do in a political market. He provided access. He carried influence. He gave the operation legitimacy near the top of the state. And yet when the signal changed, he was not protected first. He was left inside the blast radius. Some retellings add exact exposure figures for Corbin in the final hours. I have not verified the cleanest primary citation for those numbers, so they should remain flagged. But the larger point does not depend on that number. It depends on sequence. Corbin was close to the president. Gould was close to the signal. Those are not the same thing, and that is why Fisk matters here too. Multiple accounts say Gould did not fully warn even his own partner, whether from distrust, greed, or simple self-preservation. He kept the most valuable information in the one place that still mattered, inside his own book. Then morning came, and the market learned all at once what Gould had already priced in. On the morning of September 24, Boutwell sold $4 million in government gold. The price collapsed from 162 to 133, fast, violently. The New York Fed notes that stocks fell sharply with the break, and the panic spread far beyond the gold room, because grain and import markets had already been distorted by the run-up in gold. The corner in one monetary nerve center became a shock to the wider economy. And then came the familiar ending. Investigation without real punishment. The House Committee on Banking and Currency investigated the causes of the panic in 1870. Butterfield was forced out. Gould was disgraced in print, but he kept operating, and within a few years he was back at the center of American railroad finance. The state touched the mechanism. It did not break the man. That is why the modern parallel is not another gold corner. It is communication asymmetry around state power, Fed signals, Treasury intent, regulatory timing, leaks, access journalism, selective guidance, private interpretation. The instruments change. The hierarchy does not. So the survival protocol from 1869 is brutally simple. Do not confuse access with protection. Do not confuse price action with truth. And when a market depends on what the state may say or do next, ask one question before anything else. Who receives the signal first? Because if the answer is not you, then you are not inside the trade. You are inside the exit liquidity.